Welcome to this session of Market Intelligence Live. I'm Gary Regenstreif, Executive Editor, and I'm joined by Richard Mattison to look ahead to some of the key environmental, social, and governance themes in 2021. Richard is CEO of Trucost, the S&P Global unit that assesses and prices risks relating to climate change, natural resource constraints, and broader ESG factors. Richard's an expert in sustainable finance and has advised various U.S. governments, financial institutions, companies, and NGOs on how to integrate climate change and natural capital analysis into their decision-making. Thanks for joining me, Richard.
My pleasure to be here. Thanks, Gary.
And thanks to our audience for being on with us. We invite you to submit questions via the field in your platform at any time. We'll try to get to as many as we can toward the end of the session. So 2020 was significant, moving down the ESG path, not least of which companies and countries announcing net zero goals, increased focus on racial issues in the United States, and a host of other developments, some spawned by the pandemic. We're going to be looking forward, and I'd like to start with a fact from last year to set the scene. And that was from the National Oceanic and Atmospheric Administration, which earlier this month reported that the U.S. in 2020 experienced a record-breaking year in billion-dollar scale extreme weather and climate change-linked disasters, such as wildfires, tropical cyclones, tornadoes, and hailstorms. So having said that, Richard, President-elect Biden will be sworn in tomorrow, and there is an executive order plan to bring the United States back into the Paris Climate Accord. The new administration also plans to reimpose regulations that were scaled back these past 4 years, and it also intends to encourage green projects. How significant are these moves, and is there any way to quantify the impact?
Yes, I think these moves are very significant. I think the change of administration will make a major difference, actually, in terms of what is being financed in the United States with respect to climate change and with respect to sustainability. President-elect Biden has said that the effort to stem the climate crisis is the biggest job creation opportunity of the 21st century. So you can expect him to really focus on getting through his plans. He has a $2 trillion climate plan. He has a $1.9 trillion COVID plan. I think that elements of the latter we can discuss later, but the climate plan in particular will provide a lot of incentives. Tomorrow, President-elect Biden is actually likely to, in a flurry of activity on his first day, he's likely to rejoin the Paris Climate Agreement, or have the United States rejoin the Paris Climate Agreement. And so I think that will have some quite interesting implications. Countries across the world that have joined the Paris Agreement, last year, most of those countries, or countries representing most GDP in the world, have not only signed up to the Paris Climate Agreement, they've also signed up to net zero climate change targets. Those are ambitious targets, usually to be achieved by 2050. And I think that the United States re-entering the Paris Climate Agreement will likely mean the United States will also have to look at things like ambitious net zero climate change targets by 2050, which really means a very accelerated pace of change on implementing climate policy. So it'd be interesting to see exactly what happens through the first part of President-elect Biden's term.
Thank you, Richard. Let's talk a little bit more about some of those countries and some of the goals that they've been making, including China, which has pledged to go carbon neutral by 2060. Japan has made its own promises of, I believe, around 2050. So, how encouraged are you about this? More countries joining or climbing aboard the train, and what do you feel about these timelines? Are they too far down the road to make a meaningful impact, or is this the best they can do given where they are today?
Yeah, There are skeptics about those making net zero announcements being far too far out. So you have a 2050 target of net zero that requires wholesale structural change to the economy and needs to be accompanied really with 2040, 2030, 2025 targets if you're to set clear policy intentions. And obviously, a 2050 target is kind of easy for a politician to make today. Because they will not be in power in 2050. So it's a commitment to the future. But I do think that you have to look at the underlying changes that are happening in those economies that are making those commitments. They are being supported for the most part by real commitments today. So if you have a look at the European Union, for example, their net zero ambition is actually supported by a huge climate plan. Actually, they have massive ambitions and structural changes across the economy that affect investors and companies. Looking at things like disclosure, for example, in order to aid capital flow towards sustainable outcomes. Looking for widespread public policies on real economy changes on climate change. So a whole raft of different things being proposed. When the UK signed up to a net zero target, they also signed up to banning all internal combustion engine sales by 2030. So we typically see a net zero target being accompanied by a raft of policy changes. In China, in particular, what we can expect to see from the next 5-year plan is plans for mass electrification of the transportation system in China and decarbonization of the grid to support their climate change targets. And in fact, that kind of wholesale change will actually lead to structural changes in demand for oil and gas globally. So I think these commitments are, they could be seen as being lofty and too far out, but often they are accompanied by really near-term hard policies. And so it'll be interesting to see, in the Biden administration, precisely what has happened. One thing I can say, what's already happened, is that the Fed has already announced its intention to join a network of central banks very much focused on climate risk called the Network for Greening the Financial System. It's a network of central banks. For the majority of the world's central banks actually now joined up to that. And what that means is the Fed is likely to be conducting climate stress testing on US banks in particular. And that will actually change how the US economy is being financed from a private market perspective, which will accompany actually all of the changes that you might see coming through in a $2 trillion climate change plan as well.
Yeah, in that vein, Richard, some of the other policy decisions that will be interesting to watch, and one of the tasks for the new head of the Securities and Exchange Commission, if confirmed, Gary Gensler, will have to decide, among other things, whether to mandate climate and political activity disclosures from publicly traded companies in the US. How significant would that be?
That would be very significant. I mean, at the moment, just to give you a kind of benchmark, about 90% of companies in the S&P 500 publish sustainability reports at the moment. But only 16% of them have any reference to ESG or environmental, social and governance factors in their filings. So you're seeing a bit of a mismatch between what is disclosed in regulated documents versus what is disclosed from a voluntary perspective. But you already see quite a lot of companies making these disclosures anyway. What's lacking is standardization of those disclosures. And so we're seeing quite a lot of pressure coming on regulators in different jurisdictions, actually. And you've got some international bodies that are looking at various different regulatory frameworks and standards. So you have the IFRS looking at various different, they've just run a consultation on the extent to which they should be devising some kind of ESG standard. You've got the World Economic Forum, who is also looking at creating a short list of ESG standards, ESG key performance indicators. And you've actually got Europe. The European Commission has already defined a list of indicators that are relevant for the finance sector to report on, and is asking actually for the finance sector to start reporting those indicators as early as this year. So lots of push, I think, on regulators, on disclosure regulators, reporting regulators, to really make a change. I think we've seen quite a lot of discussion about this, and I think this is something that would, for the most part, be welcome from the investment community in particular, who at the moment they have the job of looking at disclosures and trying to compare apples and oranges. And so some kind of standardization around disclosure would be useful. This is what we hear from investors in particular. The SEC, I think what the SEC does this year will be very interesting. Also, what the Department of Labor does will also be interesting. So under the Trump administration, the Department of Labor was asked to investigate the extent to which large institutional investors in the United States should incorporate environmental, social, and governance factors into their investment beliefs. And the guidance, by and large, the guidance given to them was that they should not do that if it has any effect on financial return. So we'll see the extent to which some of these guidelines, some of these disclosure frameworks change under the Biden administration.
In the meantime, more companies, as you said, are signing up for the Task Force on Climate-Related Financial Disclosures, which is the reporting framework designed to provide a clear look at whether companies are on track to meet the Paris Accords goals. But do you expect that to accelerate? And what grade are you assigning to those companies for the transparency around their exposures that they're coming out with?
So the Task Force on Climate-Related Financial Disclosures is, incredibly useful framework for climate risk disclosure because it brings together the non-financial with the financial. It's designed to help a company or an entity report on climate change in a way that is relevant to the investment community. And so we've seen more than 1,500 companies backing the TCFD, as it's called, reporting framework, which is 5 times the number when it first started. And that has to, though, be countered with the fact that when we analyze companies and we look at their emissions trajectory, most companies are falling far short of the required emissions reductions to meet the Paris Agreement. And so that in itself presents quite a significant risk. In fact, we'd say the shortfall is 72%. So that really means that you can expect to see a ramping up of various different policies. Transparency will need to increase, I think, on the extent to which companies are aligned with, targets, the requisite targets on climate change as appropriate for their sectors. These are called science-based targets. And transparency also on some of the financial risks to their business model under a scenario where there is strong climate policy. So we found actually that 13% of earnings could be at risk if companies had to pay a carbon tax. And on the flip side, if there is no successful climate policy, then we would say that 60% of the S&P 500 have assets at high risk of the physical impacts of climate change. So floods, droughts, wildfires, hurricanes, things like that. So there's kind of, climate risk wherever you look, but there is a way of navigating this that can minimize risk. And I think we're going to see more requirements on companies to be transparent about how they're navigating risk on climate change.
Well, whether this comes or not from regulators, will we certainly see that increased pressure from investors?
Yes, definitely. So you've got a number of large asset managers, including passive managers, largely like State Street and BlackRock and various others, Vanguard, who are all putting pressure on companies to disclose. They are all putting on pressure on companies to disclose against standardized frameworks, in fact. And this is because, if you're a large asset manager, you have many clients, including pension funds and people like you and me, maybe, who actually want to see more transparency. I mean, we sit in the middle of the largest intergenerational shift of capital to millennials. And the majority of those millennials, 68% of millennials, would say they would prefer to create a positive impact with their investment. And so the trouble is today, it's very hard to see whether you can create a positive impact with your investment, because it's hard to get transparency in the extent to which the way in which your money is being managed for you is creating a positive impact. And so I think large asset managers are going to be placing a lot more pressure on companies simply because they themselves are under more pressure to really be more transparent and to show the extent to which they're addressing climate risks and creating positive impact through their investments.
Richard, I have a number of questions, but I have some important themes I'd like to explore before we go to the audience. ESG has been nudged forward not only by concerns of risk management, but by activism. The expectations of business leaders in times of social unrest seem to be changing, as we saw following the assault on the Capitol building in Washington a couple of weeks ago. And inaction seems less of an option as the ESG movement gains traction. What's your expectation on that front?
On activism, you mean?
Activism driving change in, in terms of public policy.
Yeah, absolutely. I think activism drives change in terms of public policy, investment behavior, capital allocation, all sorts of different things. I was at the World Economic Forum meeting in Davos last year. I saw the Greta Thunberg effect amongst the policy and private sector leaders that were attending that event. And I think activism, has a real role to play, because I think ESG can be quite a complicated suite of things to understand. It's not just climate change; it's a whole range of different topics that are quite important to a whole range of different people. And so I think some of the topics kind of rise and ebb and flow, basically. And so activism will be important to make sure that we stay balanced in our perspective on a range of different topics that are important to a range of different stakeholders. And interestingly, they're largely connected. So, for example, climate change affects biodiversity. Biodiversity affects our ability to, for example, find new medicines, and also has actually affected the rise of pandemics globally. Effects on biodiversity impact on things like water availability, and also in reverse affect climate change and have massive social impacts as well. Climate change and the physical impacts of climate change actually affect the poorest people in the United States, affect people who across the diversity spectrum as well. You're more likely to, feel the effects of climate change if you're living in a poor district in the United States, basically. The demographic of people living in those districts are people who are going to be interested in some of these social issues as well. So these things are linked, which is the reason why things like ESG investing, taking a balanced approach to looking at a number of different things, is so important, because they are all linked. And, they are linked to an investment thesis ultimately, because if we don't drive change in the world, we'll see huge instability.
Right. Richard, I have two or three questions. Let's consider it a lightning round before we move over to audience to our audience for questions. I'd like to get your view on the rise of sustainable debt, which hit a new record in 2020 for volume of issuance at a year, in the year. If I'm not mistaken, it was more than 700 billion across bond and loan varieties raised with ESG purposes in mind. That includes so-called social bonds, which are used to raise money for social objectives. I'm just curious, what do you anticipate for this way to raise capital? Is that going to will that plateau? Will that rise substantially? What's your forecast?
I think it will go through the roof. And the reason why I say that is because we're already seeing an exponential rise in sustainability-linked loans and bonds. And part of the reason why is because of the thesis of Build Back Better, or the Great Reset, as the World Economic Forum is calling it, where, as we recover from this huge global disaster, this pandemic, there is a strong rationale to say, actually, why don't we rebuild our global economy in a way that is far more sustainable and far more resilient to future shocks? That would seem to make sense. And so I think that is actually resonating a lot with various different policymakers across the world. A third of, I should say 30% of Europe's 750 billion recovery fund is dedicated to green and sustainable projects. So 225 billion euros. Add to that, the things like, the president-elect's proposal in terms of the COVID relief plan. There are large swathes of that plan that will encourage sustainable debt, if you like, to be issued. So, for example, relief to small businesses that could include energy project developments, including, focus on renewable energies and clean energy. So, in other words, incentives for low interest loans to be made to state, local, tribal, non-profit and small businesses to really serve those in the clean energy sector and to kind of build out a clean energy and energy efficient approach to rebuilding the United States. So I think when you look at that, this is a lot of government issued debt, basically, that is going to be really tagged as sustainable. When governments do that, they then attract private markets to crowd in. And so we really can, I think, expect to see quite a boom in sustainable debt issuances this year.
Thank you. You wouldn't care to take a stab at quantifying that?
I can't. I mean, I've done that in the past and been wildly wrong, so I'd hesitate to guess. But I mean, I would say that if you just stack the numbers up today, it will far exceed what we've seen last year for sure. Also, there are structural measures that are being put in place, regulatory measures that are being put in place that are a little bit subtle but very important for debt issuance. So, for example, in Europe, if you want to issue a bond, you may well have to describe whether that bond is sustainable or not in the future. Now, if you're issuing a bond and you have to label it as unsustainable, you're likely to have a higher cost of capital. In China, already that is the case. So if you want to finance a wind farm in China, it's cheaper than financing a coal-fired power plant. The interest rate is lower. So there are some structural regulatory moves by central banks in particular that are having an effect on the cost of capital for fossil fuel projects versus renewable projects and other types of sustainable investments already in place. And so those are really, if you like, incentives that could create a tipping point to a large-scale allocation of capital from a debt perspective.
Thank you, Richard. Let me ask one last question just quickly. And it's been this lingering doubt among some in the investment community about whether returns on ESG-themed funds are as attractive as those that aren't. And in 2020, there was more evidence that ESG does produce superior returns. The S&P 500 ESG index and the S&P 500 Paris-aligned climate index both outperformed the core S&P 500 index last year. And the two U.S. equity funds with the strongest returns in 2020 both focus on clean energy. So just looking ahead, is there any way to quantify or anticipate an acceleration in the shift to sustainability as an investment focus?
Yeah, I mean, there's a huge acceleration in the shift to sustainability. So there may be some debate around whether this drives better returns for investors. But I would say what we really saw last year, which was very interesting, was not only that some of the sustainability-focused funds, ETFs, passive investment structures, indices, they actually started to outperform quite significantly their benchmarks. we also saw huge inflows into sustainability funds versus significant outflows from funds that were not labeled sustainability. So that flow in itself has an effect of driving change in markets. And in fact, last year, we saw a huge amount, a massive increase, a more than doubling of ETFs that are ESG aligned ETFs, a 250% increase, in fact. A threefold increase in ESG in ETFs, and a 250% increase in SDG aligned ETFs, so aligned to the Sustainable Development Goals. So I think the flows is really the extraordinary story. The returns helps, obviously. Returns can come and go, as we know. But one thing I just wanted to point to is I think something that investors are really appreciating now is the time that we are genuinely seeing real economy changes. BP announced at the end of last year that BP announces 3 core energy scenarios for the world every year. And last year was the year that they announced that in 2 of their core scenarios, we had already reached peak oil demand. And in the 3rd scenario, oil demand will peak in 2025. So that's a kind of a remarkable scenario analysis from BP. And then separate to that, we saw Tesla becoming the world's most valuable car company. A company that is not shifting anywhere near the amount of cars that the other next largest companies are shifting. So, markets are really starting to recognize the changes in the real economy and what is going to happen. So I think 2021 will see an accelerated pace of change on that, and it'll be interesting to see what happens at the next big climate change conference in Glasgow.
Great. Richard, thank you. Let's turn to our audience. We have a number of questions lined up. We have one from Dylan on LinkedIn. Now that the Democrats have taken the Senate, what is the prospect of a carbon tax? And do you think a carbon tax is necessary to prevent significant global temperature changes?
Yeah, carbon taxes and carbon trading schemes are actually, it's the top of the agenda for the EU-US discussions. The EU is looking at border controls on carbon emissions. In other words, they don't want leakage of emissions or imports of emissions. And they're working very hard, actually, with the transition administration on things like carbon taxes, as we hear. So I expect there to be quite a lot of thinking around carbon taxes. I also think that there's a lot of different mechanisms and vehicles outside of a carbon tax that can create change and a transition to a low carbon economy. So, low carbon, low interest loans, for example, makes a big difference. You don't actually have to have a tax. You can have a disincentive, and sometimes that's equally powerful. So we'll see. It obviously will depend a lot on the extent to which some of the climate change plans can be approved in the United States according to the legislative process. But I think there are lots of mechanisms here that can be rolled out. Carbon taxation, interestingly, in Europe hasn't worked particularly well, but that doesn't mean it couldn't work in the future.
Thank you. We have another question from LinkedIn from Matt. What do you foresee as the biggest changes to the electric grid over the next 5 to 10 years? And what new investment opportunities will this open up?
Yeah, I think that's an interesting point. I think the, as we see, if you think about the low carbon transition, we see an element of decentralization. So you could actually see, less of a need for centralized grids, if you like. So you could see more decentralization, more feed-in tariffs happening as a consequence of, micro installations of renewables in some way, shape, or form. However, that could be quite heavily countered by a massive increase in electricity demand coming from electric vehicles. As we all charge our electric cars in 2030 because we cannot buy an internal combustion engine car, we could actually see a huge spike in grid demand, and that's likely. We've certainly seen it in places where there are big incentives for electric vehicles. So that itself is likely to require decarbonization of the grid. So, a decarbonization. Otherwise, you have, if you're powering your electric vehicles with coal-fired power stations, that equation doesn't work for the climate. So you actually need to decarbonize the grid if you're to encourage electric vehicles at the same time. And secondly, I would say there's a huge opportunity for efficiency. So some grids in the world operate at efficiencies of 25% or less in terms of power transmission from the power plant to the actual household. And so I think there's a major opportunity for greater efficiency. If you're going to upgrade the power plants, upgrade the grid. And that's what some economies have also done. So there's definitely opportunities there.
Thank you, Richard. From the audience, we'll take one final question, this one from Jacob. What are the most important external ESG factors, KPIs, market intelligence teams should track in 2021?
That's a great question. I mean, I think what we're seeing in terms of the kind of work that we're doing with our clients is there's a very strong focus at the moment on sustainability-linked debt and loans, and the extent to which you can prove that case. So having better credentials around some of the issuances that we see, and making sure that they are sustainable. If you're a bank and you're financing a sustainable loan, and you have to tell your supervisor the extent to which you are growing your sustainable loans, you better make sure they're sustainable. So I think there's something around the credibility of debt issuance. Climate risk in general is a huge topic, and one that's going to get much, much more specific, I would say. So looking at not just climate risk in the context of tons of CO2 emitted, but actually honing right down and looking at the credit-related climate risks. And I think that's going to be something that's a huge topic this year, is really looking at the extent to which credit risk can change as a consequence of climate change. And then drilling down into a little bit more specificity is something that we're doing, is really looking at that risk at the level of the assets owned by the companies. And that's a big job. We've invested a lot of money to do that. But I think looking very specifically at, the power plant, the mining site, the piece of real estate or infrastructure, that allows you, that level of geospecificity allows you to look at things like physical impacts of climate change and resilience. And I think resilience is going to be a big topic for 2021, because we're reaching the point where we may not be able to entirely reduce dangerous climate change from happening. And so what happens is we're going to need to look at both transition, so a reducing path towards low carbon, but also resilience, so dealing with the consequences of climate change as they hit our global economy. So looking at resilience in the context of how that might affect the assets that are being financed, I think that's going to be an interesting topic for 2021.
Richard, if I can steal just 30 more seconds of your time, and then we'll wrap up, just to kind of bookend the year, just looking ahead to November and the United Nations Climate Change Conference in Glasgow. What are your expectations for that?
Yeah, just very briefly, I would say, we've got 1,400 companies signed up to net zero. That's going to increase for sure. But there will be pressure on those companies to say, you can be net zero by 2050. What are you doing by 2025? This is the decade of change. So I think that will be interesting. I think in order for companies to really think about, companies, investors, whomever, to think about how they're pursuing a climate change path, we're going to need to look at things like offsetting. And there'll be a big discussion around voluntary carbon offsetting markets and the growth of those offsetting markets in a way that is credible. And offsetting in a way that doesn't damage nature. In fact, nature-based solutions to carbon emissions is a hot topic. So I think those types of topics will be very interesting to track as we head into the next major climate change conference at the end of the year.
Terrific. Richard, thank you very much. Just for our audience, for those who want to see more broad insights from S&P Global Market Intelligence, please visit our S&P Global website. There are more insights there from Trucost as well. as well as topical newsletters on policies and regulation and other coverage that those of you in our audience can access. Thank you so much to Richard for being with us today, and thanks to you all for joining us. We hope to see you again soon. Bye.
Thank you so much.